Welcome to the Deep Dive. Today we're digging into a YouTube video from Peter Schiff. It's called America's Trade Problems Are Made in the USA.
Right. We've got the transcript.
Yep. And the plan for you, the learner, is to really unpack what's been going on with the markets lately, how things like tariffs and, Fed decisions are shaping things.
And also the bigger picture economic challenges for the U.S.
Exactly. And we'll try to do it without getting lost in all the finance jargon. Okay, should we jump in?
Let's do it. What really jumps out right away is this big market turnaround that happened midweek.
Yeah, it started on a Tuesday, right? After the Dow took quite a hit on Monday.
It did, and it seems like the trigger wasn't, some big economic report. It was actually comments on social media.
That's what the video points to. Monday, markets down, dollar weaker, gold.
Well, gold went up quite a bit.
And it links that to Donald Trump's posts on Truth Social, going after Jerome Powell.
Yeah, the too late pal loser comments, really pushing for rate cuts. And the market seemed pretty nervous about that kind of pressure.
I think that's the key takeaway there, isn't it? How sensitive the market is. Just a few words from a major political figure can really shake confidence.
That initial reaction, the weak dollar, gold almost hitting a record, it really screamed concern about the Fed.
Concern about its independence, basically.
Exactly. That seemed to be the underlying worry. Is the Fed going to lose even its perceived independence?
But then, like you said, the turnaround. Tuesday morning, the video calls it damage control.
Trump seemed to dial it back a bit, said he wouldn't try to remove Powell.
And bam, markets reversed. Stocks rallied.
It's pretty striking, the power of just words, even without policy changing yet.
Makes you wonder, doesn't it, about timing and influence.
Well, the video does kind of hint at that, the idea that maybe these comments aren't always accidental, that they could be, timed strategically.
For trading advantages, maybe. That's a serious implication.
Yeah, it is. But it just highlights how sensitive things are. Even just thinking the Fed might change course has a huge effect.
Which leads us straight into that whole issue of Fed independence. It's complicated.
Very. Because Trump's criticism was that Powell is being political by not cutting rates.
Right. But the counter-argument presented is that, well, the real political pressure is usually for lower rates, for easy money.
So you could argue Powell holding firm is actually the more independent stance in that context.
It's an interesting way to frame it.
And, to add another layer, the video brings up that story about Ben Bernanke.
Oh, right. Years later, admitting he felt he had to kind of align his public comments about the subprime mess with the Bush administration's rosier picture.
Exactly. Even if it wasn't his full assessment.
That really challenges the whole idea of a completely apolitical Fed, doesn't it?
It definitely complicates it. It suggests there's always some level of pressure, direct or not, to, stay broadly supportive of the administration's line.
Yeah, the video mentions Yellen keeping rates near zero under Obama, then raising them after Trump won.
Patterns like that just feed into why the market gets so jumpy about anything that looks like direct political interference with the Fed, like those initial Trump comments.
Okay, so Fed independence fears played a role in the volatility. But the rally wasn't just about the Fed walkback, was it?
No, there was also this trade angle, these crafted statements, as the video calls them.
From Scott Bessent, right.
Oh.
Hinting maybe the trade war could ease up. Lower tariffs.
Yeah, though the analysis in the video is pretty skeptical, calls it likely BS.
Just talk to boost the market.
That's the suggestion, because the underlying argument is that these high tariffs on China just aren't sustainable for the U.S. anyway.
Why is that? Because we rely so much on Chinese imports.
Precisely. So, yeah, it hurts China, no doubt, but the argument is it might actually hurt the U.S. more.
And there's that longer-term idea mentioned, too, about China potentially benefiting if trade stopped.
Right, the idea of ending the vendor financing. Basically, stop selling goods on credit, effectively, to an indebted U.S. consumer. It would force China to refocus internally.
That's a really different perspective.
It is. But look how the market reacts anytime there's a whisper about tariffs going down.
It rallies.
Always. Which clearly tells you the market sees tariffs as bad for stocks, bad for the dollar, but good for gold.
So the market view is pretty clear. Tariffs are a negative.
Yeah, but the video is also skeptical they'll actually come down easily.
And it brings up other trade talks, like with South Korea.
And it points out their average tariff on U.S. goods is like less than 1%. Really low.
Which is interesting when you compare it to what U.S. tariffs on their goods were before the trade war, around 3.3% apparently.
So using Trump's own ripping off logic, it kind of flips the script, doesn't it?
A bit, yeah. And it mentions India, too, also having low tariffs.
Leading to the bigger point. Maybe tariffs aren't even the main driver of trade deficits.
The video suggests even if everyone went to zero tariffs, the U.S. deficit might not change much,
Which brings us back to Trump's "he who has the gold makes the rules" idea.
where the gold is the American consumer market.
Right. But the video critiques that, saying it's probably unrealistic to think foreign companies will just eat the tariff costs or suddenly move factories here.
So the likely outcome is,
Right.
what? Higher prices for us?
Either higher prices for American consumers or those goods just become unavailable. That's the argument presented.
Okay. Shifting gears slightly, what about the broader economy? The video mentions Austin Goolsbee.
Yeah, the Chicago Fed president, downplaying tariffs because imports are only 11% of the U.S. economy.
But the counterpoint is crucial, right? That 11% isn't isolated.
Not at all. It's deeply woven in. Disruptions ripple out. Think trucking, retail, jobs. It affects everything.
It's not just a number.
Definitely not. And that interconnectedness seems underlined by some other weak data points mentioned.
Like existing home sales, weakest March since '08.
Yeah, and also a really high rate of mortgage refi applications getting rejected, the highest since 2013, apparently.
That suggests households might be feeling the strain.
It points towards financial stress, yeah, and supports the broader argument about whether current policies are sustainable.
Okay, let's talk gold and Bitcoin, because there were some weird moves there too, weren't there?
A little contradictory, yeah. Gold rallied initially, but then finished the week down, even though the closing price was still high.
And the miners. Newmont had a huge earnings beat, but the stock dropped significantly.
It's pretty wild. Newmont beat estimates by 42%, revenue up 25% year over year, profits up like 127% quarter over quarter. Huge numbers.
And yet the stock fell.
And then you contrast that with Texas Instruments, a smaller beat, less growth, but their stock jumped.
So it really highlights that argument about gold stocks maybe being undervalued.
That's the perspective. That gold itself has been underpriced and underowned for a long time, while mining costs went up with inflation.
So maybe these higher gold prices are here to stay, making the miners look cheap even with volatility.
That seems to be the thinking, that there's potentially a lot more upside for gold and therefore the miners.
And Bitcoin. It rallied too, but apparently it just tracked the NASDAQ.
Pretty much mirrored the tech stocks, yeah. Which kind of contradicts those earlier ideas about it being decoupled, its own thing.
So not acting like digital gold in that instance.
In fact, the video calls it the anti-gold, noting its rally happened when gold itself pulled back. Suggests maybe an inverse relationship sometimes.
Interesting. And there was also a mention of the administration wanting the U.S. to be a crypto superpower.
Yeah, but the point raised was, well, how does that fit with trying to reindustrialize America? Seems like those goals might clash. Competition for capital, maybe? Focus?
Good question. Okay, finally, let's touch on Trump's approval ratings.
Right, the video reports them as being historically low after 100 days. Lowest in decades, even lower than his first term at the same point.
Why? What's the explanation given?
Basically, very high expectations set during the campaign, an immediate economic boom that just haven't panned out yet.
But the video also argues the underlying economic weaknesses were already there, right? Predating Trump.
Exactly, that these trends have just continued.
So while the media might blame Trump and tariffs,
the argument here is the tariff pain might still be mostly in the future, and the current issues are more about those pre-existing conditions.
and it pushes back on the idea that this is just necessary pain, like ripping off the Band-Aid.
Yeah, it refutes that by saying, look, the policies being pushed, more deficit spending, pressure for low rates, are kind of the same policies that caused the problems in the first place, not a correction.
It emphasizes the history, too, doesn't it?
Yeah.
U.S. trade deficits going back to 1975.
Way back, to make the point that this isn't just about the last few years or one administration.
So the core argument seems to be, tariffs are treating a symptom, the trade deficit.
When the real cause is deeper. Living beyond our means, enabled by the dollar being the reserve currency.
That's the root cause identified in the video.
And the conclusion is pretty stark. The U.S. has been kind of taking advantage of the global system, and the real fixes need to be domestic changes, not demands on the rest of the world.
Wow. Okay, so wrapping up this deep dive, we've seen quite a few interconnected themes.
Definitely. Market swings tied to political talk, the whole Fed independence question.
The complexities of tariffs and trade wars, potential harm there.
Those odd disconnects between earnings and stock performance for things like gold miners.
Contrasting that with Bitcoin's moves.
And all underscored by these bigger, long-term economic challenges facing the U.S.
So for you, the learner, the takeaway is really that understanding this stuff means looking, beyond the headlines.
Yeah, you have to consider different angles, how these pieces all fit together. It's complex.
Absolutely. So here's maybe a final thought to chew on. If trade deficits are a long-term issue and there's ongoing pressure on the Fed, what domestic policy shifts really get to the root of these economic vulnerabilities? Something to think about.
Definitely food for thought. We encourage you to keep exploring these topics.